Hey everyone. Sorry we haven't had a podcast for a while. One thing that's happened is myself and Raphael are on different continents now, and it's hard to connect at a certain time to have a podcast. But we will get to that. But in the meantime, here is just a refresher and an update on some of the things that we've talked about in our podcast. And really, one thing that's important is refresh and make sure you understand the messages that we've been trying to get across. And the overarching message was, hey, you know what? Interest rates may be rising. And if that's the case, they may cause stocks and bonds, usually the two building blocks of investment portfolios, it may cause both of them to decline. And because of that, you want to think more broadly about diversification and how you adjust your portfolio so that if that scenario emerges, that your portfolio won't decline dramatically overall. You want to have ideally assets that will move in different ways over time so that your portfolio is at least moderately stable. And one of the things that we've talked about is, hey, gold over medium to long periods of time can be very uncorrelated with stocks and bonds. But also in short time periods, they can be very correlated. So what we were emphasizing was not necessarily to invest a lot in gold yet, but rather to have a good chunk of cash. Maybe it's 20%, 25% of your portfolio in cash. And basically, the year and a half ago, we said, hey, the best asset to have, or at least one important asset to have in your portfolio is cash. And that gives you that opportunity to buy if things go down a lot. And hopefully gold goes down a lot at that time, and we can invest a lot in gold and gold mining stocks so that we can build a portfolio that's better diversified over the next 10 to 20 years if interest rates go up. Now, there's no guarantee that interest rates have to go up, but we're saying, you know what, the conditions look like they're there. That could happen. Okay, so what have we started to see over the last year and a half, but another phase over the last several months is interest rates have gone up. We've seen bond prices come down, and it kind of looks like stock prices are starting to come down. And a lot of other asset classes starting to come down. Bitcoin, gold, it spiked up, starting to come down again. So we're still kind of at this waiting phase. And I know our message in the podcast has been, just be patient, be patient, be patient. And it's still be patient, but some interesting things are happening. And I'm going to go through them in this video, just nice update on where things are at and some interesting things that have happened. So the first thing I want to do is show a very interesting graph to you before I get into some actual investment markets. So here's a very important graph to understand the world really right now and potentially our world for the next 10, 20, 30 years. Okay, this is an important graph. It's a simple one, but a really important one. Just give me a second while I bring it up. Okay, here is our very simple but critical graph to understand our world now and our world in the world over the last 40 years, the last few years, and perhaps the next 20 or 30 years. Okay, so this is a graph of prices versus yields, or prices versus interest rates. Now, this graph is very specific to the mathematics of a bond. Okay, and the idea is as yields go up, prices go down. So this blue line illustrates that with higher yields, you're going to have lower prices, and lower yields, you have higher prices. If you're familiar with the mathematics of finance, not a big deal, but maybe you aren't. But this is really fundamental idea. But here is what is really, really crucial right now. If you look, when yields are relatively low, right in here, what happens to bond prices? Well, as yields go down, and they're really low to begin with, prices go up a lot. Okay, yeah, you know what? Maybe 100% increase just for a relatively small decline in interest rates when interest rates are already very low. Now, it also works in reverse. If interest rates are really low, close to zero, and they start to go up, prices can fall quite a bit, 50%, 60%. It doesn't take much in the way of interest rates to go up to have a very dramatic impact on bond prices. Now let's extend this to other asset classes. So this is a very precise mathematical relationship for bonds and interest rates, bond prices and interest rates, because they have fixed cash flows. It's relatively simple to do the calculations on. When you get into things like stocks, the relationship does hold, all other things being equal, but there's a lot of other things that impact stock prices. Different stocks have different sensitivities to the economy. Some stocks, like say Tesla, the expectation is they're going to grow their production year after year for many years, and it's more of like a really long-term bond with payoffs far in the future. So that can be really sensitive interest rates. So as interest rates go down, it can go up a lot, and vice versa. As interest rates go up, the price can go down quite a bit. So there's a lot of fuzzy things when you get to stocks, but this relationship should generally hold over medium to longer terms. Similarly, you get into other assets, let's say Bitcoin or gold, which are unproductive assets that just kind of sit there, right? They don't produce cash flow or anything like that. So they're a very different asset. But similarly, when interest rates go very low, the opportunity cost of holding them drops and they can go up a lot. So all asset classes in some way are impacted by interest rates. And if we're in a situation where interest rates are starting to rise, it should impact all asset classes in some way, negatively impact them. Now, you might say, well, and then everything is a derivative of interest rates. And to some extent, it is. And even just to broaden it even more, things like Netflix charging their subscribers. Oh, my rate went up. Oh, they're not allowing me to share my password. What's going on? Well, you know what? Interest rates going up are going to impact a lot of things in our lives, and they've only gone up a little bit. I know I'm trying to connect a few dots that are a little bit harder to connect, but it's a fundamental factor that's going to impact a lot of portfolios, okay, and a lot of investments. So the one thing that we've said for the last year and a half is that's important to have in your portfolio is cash. Well, cash, it's not impacted by interest rates. Okay? It may be impacted because there was inflation and you're not earning anything to cover off that inflation. But as far as interest rates go, it's fairly stable. So if we have a scenario where interest rates rise, you want to have a portion of your portfolio in cash so that as asset prices drop in different ways at different times and over time, that you've got some cash to invest at that time. Okay, so even though this podcast is about gold, we've been trying to remind people, buy a bit of gold when the price comes down, but we're not yet at that time to say, yeah, now's the time to put 20% of your portfolio, 25% in gold or gold mining stocks. It's not yet time. We want to let this scenario unfold, if it's going to unfold, before we really, release the Kraken, as the kids say, or whatever, whoever says that. Yeah, so that's what's happening. Because we're in this low interest rate scenario, we can have very large asset prices rise, enormous asset bubbles, but it can happen in reverse. And I think it's starting to happen. So let's go through a few different investments. Okay, so here is United States 30-year interest rate, just to illustrate this. So we just back up, interest rates for decades dropping. You can't really see it here, but dropping, little spikes up and down here. But what did we see? Over the last while, we started to see interest rates go up. Okay, and certainly over the last, say, 6 months, interest rates, long-term interest rates have started to go up. And we can look at Canada. Let's go to Canada 30-year. Yeah, in fact, it's on a relative basis, it's gone up even more. Let's look at the German 30-year. So this is, I think, the third or fourth largest economy in the world. Hey, their interest rates, they were negative for a little while, very close to zero. So right at that point, that point on the graph where asset prices are going straight vertical, well, now those rates have started to go up. Now, it doesn't mean they have to keep going up, but this is the scenario that we've been talking about for over a year and a half. We want to be prepared for interest rates going up, what that's going to do to asset classes, and how we can position our portfolios. Also, let's look at something like Bitcoin. Well, what's been happening to Bitcoin? Well, as interest rates over the last several months have been going up, Bitcoin's been going down a lot. Let's look at GameStop. It's been pretty crazy, but you can see this vertical rise. When interest rates are really low, things like that can happen. Now, obviously, there's a lot of other crazy things going on, but it's been going down. Let's look at bond prices. Here is a very prominent ETF. Prices were in the 160s, 150s, and over the last 6 months, this bond ETF, very popular bond ETF, has declined 25, close to 30%. That's a big change. But when you look at that original graph, this should be expected. These kinds of, zoom up, zoom down is what you get when you're close to 0% interest rates and they're either moving closer to zero or away from zero. That's what's happening. And if this continued to happen, bond prices falling another 30%, 40% would be expected. Okay, let's look at the S&P 500, the most prominent index in the world, stock market index. It was going up, up and up and up. But what's been happening over the last 5-6 months? It started to go down. Now, again, it doesn't have to mean it keeps going down, but this is the scenario that we've been talking about for over a year and a half. You want to make sure your portfolio is prepared for that. Now, let's look at gold. Say, oh, this is a gold podcast. Isn't it about buying gold? No, if you've been listening carefully on this podcast, you should understand that, yeah, we're saying gold is going to be a good long-term investment. Have a little bit in your portfolio when it drops for now, but let's be patient and wait for much bigger drops. Doesn't have to happen, but usually it pays to wait for a bigger drop. And again, if interest rates start going up more and more and more, we could see a fairly large decline in the price of gold. And over medium, like 5 to say 15 years, Gold should behave very differently from stocks or bonds under very different interest rate scenarios. But in this shorter term time period where interest rates are moving away from zero, it doesn't have to happen, but if that happens, we'd hope that there'd be some sort of decline in the price of gold. And that's when you really make a large investment. That's when you can say, okay, things have come down. What are some things that are going to be different, perform differently over the next 5, 10, 15 years? Okay, so that's what we're waiting for. Yeah, we've had some spikes up, some spikes down, spikes up, but we're looking for something more significant. Maybe another 20%, 25% decline in the price of gold. We're waiting for sentiment to be, this is the worst possible investment. That's what we saw in March 2020. This is the worst investment you could ever make. That's when you invest. So we're waiting for those kinds of moments to make an investment. We're kind of getting there. I mean, you're seeing more articles where people say, well, inflation is up and this is happening and so forth. It's not a good investment, but we're waiting for just that bigger sentiment where everyone gives up, and that's when we're buying. And there's a lot of people that are leveraged, thinking, the gold has to go up. They get really leveraged. They borrow too much to buy gold or buy other investments, Bitcoin, and those people, they get wiped out in a crash. They're forced to sell. That's when we want to really make that investment. Okay, so we're patiently waiting for that kind of thing. Now, when I talk about, okay, you know what, over the last year and a half, cash is actually the most important, a very important asset to have in your portfolio. We could have maybe called this podcast "Cash for a New Generation" because that has been the most hated asset for the last while. And when I say cash, I'd even fine tune it and say, if you could, it'd be US dollars. Okay. No, everyone is like US dollars. Like, remember we had podcasts where a guy was ripping up $100 bills saying this is worthless. We've had, people, pundits, political pundits. Oh, the reason gas prices are going up is because the government is spending too much into these US dollars. Well, what has been happening to the US dollar over the last several months? Well, this is a US dollar index. It's a combination of euro, yen, Canadian dollar, Swiss franc, a bunch of currencies. That index has been steadily rising over the last 6 months. Okay. That's a sign that people are probably too leveraged against the US dollar going up. And there's a chance the US dollar goes up 10, 15%. Maybe not more than that, but there's a chance that is something we're going to see in the not too distant future. Doesn't have to happen, but if it does, it's great to have US dollars. Now, don't go crazy, but US dollars, Canadian dollars, and then you're ready to pounce when everyone, lots of other people are forced to sell. Now, I want to show you, just for some fun, maybe you've heard about this in the news, but the Terra Luna blow up. So this is a graph of the stablecoin, quote unquote stablecoin, which allows people, in various cryptocurrencies to exchange their cryptocurrencies for US dollars without having to involve a bank. And as you can see, it was right around 1-to-1 with the US dollar. And then in the last week and a half, it's declined to almost zero, right? So these are the kinds of things that we're waiting to happen, not necessarily in this quote unquote stable coin, but in other assets, hopefully in gold, hopefully in gold mining stocks, where we can come in and buy at much lower prices. That's what we're waiting for. And we have to be patient. Is it months? Is it 12 months? 3 months? 15 months? Probably something like that. But otherwise, let's be patient. Now, what's interesting about Terra, just as a funny side note, so I don't know all the details about Terra, but it's some sort of the stable coin. There's some sort of organization behind it. They recently, 2 weeks ago, made a big announcement that they were sponsoring the Washington Nationals baseball team, probably as some way to lobby, U.S. government in Washington, D.C. Anyways, they signed a 5-year sponsorship agreement with the Washington Nationals. It's all over their stadium. And then 2 weeks later, it's almost at zero. So crazy things are happening. But when you think of that graph, that original graph I showed you, that could be the norm. Crazy things happening. I think we've seen half of it with all these crazy speculation over the last year and a half, 2 years. We may be into the other half, which is crazy things on the downside. So that's what we've been talking about. It might be unfolding now. Be patient. Have a decent amount of cash. Doesn't have to happen. So doesn't mean sell everything, because maybe it won't happen. But if you have that cash, you transform your portfolio in a way that allows you to take advantage of the potential unfolding possible craziness of interest rates going up some more. Okay, so that was our update. We will try and get back to regular podcasts, but I think that's just an important thing to refresh you on. Make it clear the message is, yeah, gold will be a good investment. Have a little bit, because it might spike up here and there. And it makes you just a little more comfortable. You've got something. But the real opportunity in gold is not yet upon us. Hopefully it happens. And you want to be in a position where you can take advantage of it. When all hell is breaking loose, you've got that cash to step in when everyone else is, many other people are forced to sell. Okay, we will get you a podcast in the not too distant future, but here, that was your update, and good luck with your portfolios and navigating these very interesting financial markets.